Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, May 21, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Not much has changed. The market is grinding up toward our trend line. She's taking a long time to grind up there, made another new high today. That's more inconsequential than anything else. We're looking for institutional conviction. We're looking for hints or clues. This is the beginning of a new leg higher. And what you have over the last several days, if you look down at the bottom, is waning velocity as the market creeps along toward our trend line. Now, once upon a time, several days ago, that trend line was a stone cold short with three hands. However, the more time they eat off the clock under the trend line and creep up there, it takes the luster off of a trading opportunity, not necessarily changing the scope, the reason the trend line is there, the effect the trend line will normally have over time. But from a trading perspective, on a hit of the trend line, it's not the same as if they came into it, let's just say, back in Wednesday of last week. We're not really enthralled as traders with what we call a creeping market. We want the crisp move to the place and the reaction from the place. Generally speaking, the faster they move to a place, the more evidence there is they're actually headed to a specific destination. Here, they're creeping along. Nevertheless, the big picture is the market's at another new high. There's nothing wrong with the tape. She's bullish. She's also getting, and we've seen this many times before, a little bit far from home base. What's home base? The 20-period moving average. Markets generally don't like to get too far. That's the red sloping trend line. Too far from home base. Therefore, what normally happens is she'll move sideways for a while, give home base a chance to creep up to price. She'll move down in some kind of a retracement / corrective format, giving price a chance to come back toward home base or a combination of those things. Right now, home base is creeping up. Price is creeping sideways. Home base, we like to call it somewhat of an anchor to price. Couple of important things we have on the docket this week can spark a move in the market, can be an excuse for a move in the market. We've got NVIDIA earnings tomorrow after the bell, I believe. We've got Fed minutes, which is regurgitated information. We already know Fed minutes are due to be released on Wednesday. However, if the market moves, it's certainly going to be because of the Fed minutes, but the Fed minutes are just a watered down version of what the Fed discussed in the prior meeting. The Fed isn't really in the business of issuing surprises to the marketplace. A lot of traders are waiting on the Fed minutes, thinking the market's going to move. I'm not in that camp. I think it's just an afterthought. Here's something else that I find a little bit interesting. Here, we're looking at the RSP. What's the RSP? It's like the SPY, only different. So this one is the S&P 500 equal weight ETF, exchange traded fund, which means that every single issue in this fund, all 500 stocks, are divided equally in the fund. So this is a real representation of what the S&P 500 is doing, as opposed to the top-heavy weightedness of the SPY and the actual S&P. Does that really matter? Does it change the price of the S&P? No, but this speaks to broadening or non-broadening of the index itself. Now, a lot of traders will look at this and say, hey, look, this is a negative divergence. So you have over here a high, and so far you haven't eclipsed the high, you haven't made a new high, so you have a lower high situation, eating time off the clock nonetheless, but still a lower high situation, as opposed to flipping back over to the SPY where you've already made a new high. The old high was 524.61. A lot of traders will want to say this is a negative divergence against the S&P. We can also flip that on its head and say, hey, yeah, it can be a negative divergence, or we could start to see more of a broadening out process from this point forward, or has been occurring, just hasn't taken hold all the way through yet. And therefore, that could be a driver to new higher prices in the S&P. It works both ways. You don't know which one it is. Be careful of the folks that tell you about the negative divergence. They may be right, yet they may not be looking at the full picture. They may not be an umpire calling balls and strikes. They may be a player on one team or the other. Be careful of getting the game summary from a team member on one side. It's got built-in bias. Let's keep in mind, just like we had the last 3 sessions in a row, this was another rather narrow-ranging day in the S&P. Here's a 5-minute chart. It's even narrower than it looks on the daily chart, because here was the range for the majority of the day, minus the last, let's call it, hour-long jam session / ramp up in the S&P. But this was the range for the majority of the day. Opened a little bit lower. Buy the dip crowd was right on cue, bought the market up. We were trying to buy it a little bit lower from an inside the number perspective. They just didn't give it to us. I was looking at a bear pivot, which would have been a buy area, which you'll see later, 528.70. They came short of 529, never got down another 30 or 40 cents. Took off to the upside, and that was it for the support area early buy, participate in buy the dip crowd situation. Did we have some traders riding it a little bit today? Of course we did, but I was looking to buy it down at 528 for the whole kit and caboodle. Pause the video, read the notes, go back to the chart, and double check the work for sure. The early scoop at 9 o'clock was a buy zone. They never got down there. We know what happens if they get above yesterday's gap, which was around 5:30 today. They go up to yesterday's highs. They did that. They poked their head above this afternoon, and they made a new high. There's no magic, no revelation. Pause the video, read the notes. It's all in here, but there was not much to really be discussing throughout the trading day, as they were dead as a doornail. It was like, once again, for the 3rd time in a row, watching turtles watch paint dry. What about stocks on the move? We had 3 possibilities today. We had PanW, Baidu, and Baba in reverse order. Baba was the only one that hit the official number on the day. Baidu came up a few pennies short, but nevertheless didn't hit it. So we'll take a look at the chart of Baba. 85.52 was the number in Baba. They came into the number, they found support, and then they ripped it back up in the other direction. Hence, the numbers work. We have NVIDIA earnings after the bell tomorrow. We'll take a look while they're doing that, tomorrow's video. But just in advance, take a look at it and say, well, if they're going to pop this thing, then 1,000 and a spike above 1,000 is an obvious thing. Being at 955, that's just a stone's throw away when you look at the price of NVIDIA, the movement that it can make on earnings. Figure anywhere from 5 to 7% is the general implied move. It's probably around there tomorrow, 7-8%, 5-6-7%, something in there. Volume in NVIDIA today was very, very light. NVIDIA players, NVIDIA watchers, NVIDIA investors, traders, all those people are waiting on NVIDIA earnings. What's going on over in Camp IWM? Didn't go anywhere today. Very narrow range, finished down 20 cents. No big deal. There's really no change from yesterday. They're still just eating time off the clock under 210. 210 is no longer considered a verifiable resistance area. They came up close. It's unfinished business, but they've been eating time off the clock for 5 trading sessions. Not much we can do with that other than the fact that just say they're eating time off the clock to build energy to move higher. unless they fail. Where do they fail? By getting below this low here, call it 207. If they get below 207, they start trading below that. That would be trouble in the short run. They would be headed back toward, not to, but toward the 20-period moving average. Big picture stuff. Traders inside the live room tomorrow will have those numbers at their fingertips one way or the other. If it's moving, we have the numbers. If it's not moving, we still have the numbers. We do the numbers every day regardless. We've got them on IWM, we've got them on the Qs, we've got them on SMH, IYT. Whatever traders want them, we've got them. My favorite market leading indicator, no real change. However, my second favorite market leading indicator, there was a material change. This is my favorite, and we know this, canary in the coal mine. Generally speaking, the way I look at this type of activity is the transports, which is a gauge for the overall underlying future health, projected, if you will, by traders, by money flow, health of the economy. It's just that simple. Somebody, something is telling us there is trouble ahead. This is my canary in the coal mine. Just in the last few days, what they've done is they've run up to run a test and spike through all the moving averages. They failed, and now they've gotten back below or recaptured all the moving averages on the daily chart from just the last few days. I think that's interesting activity. I think it's of note. I believe it's a puzzle piece. It's on the table. Look at the weekly chart. Now, I know we're only halfway through the week, not even. However, they're giving up the 50-period moving average on the weekly chart after recapturing it and trying to recapture the 20. Every opportunity to turn this thing bullish, and they chose the other way. There's something going on here until or unless they turn around and recapture these moving averages on weekly close. This is telling us something. It's foretelling something. You don't know that it's tomorrow, the next day, next Tuesday. It's a concept. We've got to file it away. It's a puzzle piece. The transports are speaking to us. You've got to heed that information. What about the Q people? Anything going on over here? Nope, just pushing to new highs. Nothing to see here. We talked about it last night. Same thing holds true. Looking for, if anything, a sign and or signal of a trend change. This is a situation where if you're long technology, long the Qs, long stuff inside the Qs, you're just riding the wave until she throws you off. Taking profit along the way, letting the trailer go until she puts in a sign and or signal of a trend change. What about the financials? A little bit of a bounce back type situation today. We'll call it a dead cat bounce for now. Retraced about half of yesterday's down candle. No big deal, no revelations. Big picture is, above all the moving averages, the trend is your friend. Yesterday was a one-day correction. That's all it was for now. When you look at the weekly chart to get a different perspective, you see that last week they made a new high. They closed at a new high. This week they're just pulling back a little bit so far, but there's nothing wrong with this particular issue, nothing wrong with this chart, nothing wrong with this tape. Above all the moving averages, you can finish the jingle. SMH didn't do anything today. Again, like others, just eating time off the clock. No new information, basically going sideways for 4 or 5 days. Building energy to do what? Well, building energy to test this high. That's the only thing above. They're just going sideways, 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 building energy to go there. Now, if they fail, they fail. But above all the moving averages, she's bullish, and we'll just leave it at that. Again, the perspective from a weekly chart came down to test the 20-week moving average, bounced off of it very quickly, right back toward the old highs. That's all that happened in the SMH. Nothing more, nothing less. You can take the news, jump it around, pick it apart, pick out stuff you like. If you're biased in one direction or another, it makes no difference. That's what happened in the semis. There's nothing to see here. It's bullish in an uptrend until it's not. What about crude oil? Get a lot of questions on crude oil. Made some promises that I talk about it tonight. This is a bearish pattern underneath the moving averages, and you can see the bearishness here. This is a flaggish, wedgish, you can call it whatever you want-ish. It doesn't matter what the name is. What matters is you have a flagpole. You can do it from there. Up here, it doesn't make any difference. You can say you have a flagpole. You have some kind of a flag forming. This is a channel. Unless they break the chain, meaning they start trading up in this area above the channel toward this moving average, this breakdown candle high. Until they do stuff like that, then this is not breaking the chain. That will break the chain, but unless they do that, this is a bearish pattern building energy to make a move higher. So think about this logically for a second. What have we looked at just tonight? We've looked at oil. Oil is setting up to go lower. Whether it does or not is still an open question, but let's talk about what the chart is setting up to do at present. We're going to take it at face value. She's setting up to go lower. That means just in concept, the big picture stuff is, would you need less oil or more oil in a contracting economy? Well, you'd need less oil. That's one reason it may be going down. What about the transports? Would you need more transportation or less transportation depending on what the economy is doing? Well, if the transports are telling us contracting, meaning we're going to need less of the transports to move stuff around, therefore, they're selling them off. Price is contracting. They're telling you in the future transports are weak because we think the economy is going to contract. That's what the chart is telling us. It's an interpretation of the chart. Now you put those things together. You got the transports telling you one thing. You got oil telling you the same thing. Those two things, in a sense, are linked together, talking about the future health of the economy. Now, what happens if oil shoots up and the transports shoot up? Well, that conversation goes out the window. But that's the conversation today. We can only go by what the charts are telling us. If the charts change, we change. How do you like dem apples? How about gold? Another one I get asked a lot of questions of. What about gold? What about a pullback? What about buying gold? All that stuff. Now, I've said this for years, and I'm going to continue to say the same thing. Gold is in a long-term uptrend. Pullbacks are meant to be bought. Said that for years and years and years. And it's unfolding as correct. So the question is, where are they going now? Well, they're just pushing up in an uptrend. In fact, I don't really even know where the end is going to be in the end. You want to say gold 3,500, 4,000, 5,000? I have no idea. Anybody that professes to know is making a guess and making you believe they know. Where can you buy a pullback? That's a more important question. Well, there's a few things on the board. Near term, there's some support at about 23.50. What happens if they below 23.50? Then you're looking at 22.50, and here's the absolute preferred thing. Not going to happen anytime soon, but if they came anywhere near this, right down here, 21.60, that is a buy 'em with both hands situation. So you have, that's the buy 'em with both hands. You got something right around here at 23.50, and then you've also got this breakup candle low and a gap. So we'll call this area right around 22.40, 22.50, another spot. When you look at the monthly chart, this was your breakout area from this high. This is a trend line, this high. They fought through it for several months, finally broke out above. So that's a whole nother situation. So this will correct at some point. It's a matter of how much and when. Don't chase it. You have to buy a pullback. When you chase it, you're liable to be wrong the large majority of the time. Silver futures, same routine. Look where they are relative to the home base, 20-period moving average. So this is getting rather vertical. They will come back toward home base. It's also in a long-term uptrend. Chart doesn't look the same, but they look very similar between gold and silver. This will retrace. Retracements are meant to be bought. You have to wait for them to happen. Where's this going? Well, the all-time high is right around 50, I believe, and there's nothing to say they can't or won't get up there. It's a matter of time. Where's the next major target? There's your blue line. That's your major target. Doesn't mean they get there anytime soon. Major target, overhead resistance, magnetic once they start to get close, and it's at 39.60. You can see it right there, 39.60. $33, near-term resistance. $33, silver futures. Have I told you how much I appreciate each and every one of you? Without you, these videos, they're not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.